Okay, welcome everyone to this webinar of ours. This is the beginning of hopefully a series of webinars that we plan to be holding from Macro Hive. We're calling this the Macro Hive debates series. The first one will be on the topic that is being the big topic for market participants over the last few months or so, which is inflation. So will we see transitory inflation? So will we revert back to lower inflation after this next few quarters of high inflation, or will we end up having persistently high inflation going forward? It's a big debate, and we have two excellent speakers who will be debating this, who I'll go on to introduce in a few moments. Now, just for the benefit of the audience here, I'll give some background of myself and also Macro Hive, and then we'll go straight into the debate. So my name is Bilal Hafeez. I'm the founder and CEO of Macro Hive. In terms of my personal background, I've always had a research background on the sell side. I started off at JP Morgan in the late 1990s, focusing on FX research early on. Then I moved to Deutsche Bank in 2002, where I was there for a long stretch of time, for around 13 years or so, where I covered a number of different areas. FX research, I did Asia research for a few years, did cross-asset research, and then I had 3 years at Nomura up until 2019, where I ran international strategy there. And then I set up Macro Hive in 2019 with a great team of people, and we've been going strong for almost 2 years now. And one of the reasons I set up Macro Hive was because I was finding that doing research on the sell side, especially since the global financial crisis, was becoming harder in many ways. My view, my philosophy is that the best way of coming up with great ideas and insights for markets and to come up with great investment ideas is ultimately you have to interact with other investors, other smart people in markets. And through those interactions, you end up coming with great insights into what the next big trend or what the next big trade is. And when you work at a bank, it's much harder to have those interactions with other people. The regulations are very strict around how you interact. Now, Macro Hive, our philosophy is to work within a network. So we're constantly engaging with smart investors, with subscribers to our site, other smart intellectuals and academics, policymakers, and so on, to make sure that we're kind of at the center of the information and idea flow. And that really goes to the heart of what we do at Macro Hive. So that's kind of the philosophy of Macro Hive. In terms of what we offer as a service, we essentially have two types of products. We have something called Macro Hive Prime, which, if I share my screen, you'll see. Just give me a moment. So this, if you go to the macrohive.com website, you'll come to this, which is what we call a Prime product, and this is kind of a great selection of research-based investment ideas written by people within Macro Hive, but also people outside of Macro Hive as well. What we do on that side is we try to pick out the best independent researchers in the market and ask them to write opinion pieces for us. So this piece, for example, at the moment is a very popular piece written by John Butler and Andrew Simon on how gold prices are set to rally. They made some excellent calls over the last 12 months. They wrote a piece last summer on how corporates are likely to buy Bitcoin. And soon after that, a whole bunch of corporates did announce that they'd do that. Here's a piece on vaccination rates. And then there's this piece here, which we just published by Sam van der Schoepbrugge on how have global capital flows changed. And this is something we do, which is we summarize the best recent academic papers. So this is a summary, a 4-minute summary of BIS working paper. So again, this goes back to how we think about the importance of being networked. If you do want to subscribe to this, it costs like $30, $40 a month. The first month or so is free. You just go to the website and you click on subscribe, and you come to this page, and you just put in your email address and so on, and you sign up. It's an excellent sort of product, and it's a great product for individuals. And so I'd urge you to sort of sign up to that. The other product we have is a much more high-end product. We call it the Macro Hive Professional product, and this is for the kind of professional investors or institutional level investors, so asset managers, hedge funds, and so on. subscribe to this. And this is kind of much more detailed, more in-depth, very much investment ideas, trade ideas, type of research. So for example, here we have momentum models, we have a rates weekly where we're kind of talk about, inflation swap curves, box trades and such things. And then also this is the place where we put out our trade ideas and trade recommendations. So if you're a subscriber to the professional product, you receive all of our trade ideas. So this is currently some of the trades I have on: short Aussie CAD, this box rates box trade. We track the P&L of the trades. We've done very well since we launched the model portfolio, up 18%, sharp of 2.5. And if you are interested in this product, just drop me an email, Bilal@macrohive.com. So that's something about sort of Macro Hive. In terms of the debate today, the structure will be we'll have our two sort of speakers who, let me introduce them. We have Phil Suttle, who is a very accomplished researcher. I actually worked with him many moons ago at JP Morgan, but he's worked at JP Morgan, Barclays, IIF, and now he has his own independent research company called Suttle Economics. And I think Phil is one of the best global economists out there. His daily, I think, is probably the best daily that is around. So I do urge people to follow him, and I'm a keen listener to what he has to say. And then the other person we have speaking in this debate is Dominique Dwor-Frecaut. She, again, I think is one of the best economists out there. She's has a very accomplished background. Amongst other things, she's worked for the Fed, the IMF. She worked for Bridgewater, the hedge fund. Now, as she's so good, we hired her at Macro Hive as well, and a real kind of iconoclastic sort of thinker. In terms of the sort of structure of the debate, we're going to go for sort of classic debate rules. So what I'm going to do is I'm going to get each person to speak for 10 minutes to present their cases. Phil Suttle is arguing for high inflation. Dominique is arguing for lower inflation. Each will have 10 minutes to present their case, and they'll have their slides to accompany their views. Then each will have 5 minutes to rebut a rebuttal against the other person. So each person will have 5 minutes. So Dominique will have 5 minutes to rebut what Phil said, and Phil will have 5 minutes to rebut what Dominique said. Then we'll open it up to Q&A. If you do have questions, just post it. There's a Q&A icon at the bottom. Just post your question there or in the sort of message area. Then I'll kind of click the questions and I'll start firing the questions up. And we'll try to get the whole thing wrapped up in under an hour. So we'll try to get this done by 5 o'clock UK. So with that, let us start with, let's sort of set the scene for this debate. One thing I wanted to do, to be very clear, is first, as a moderator, I wanted to define what we mean by inflation. So what we're talking about here is CPI, inflation in the US. So there's a lot of people on Twitter and so on that argue that commodities going up is inflation or equities going up is inflation. But in this debate, we're talking about US CPI inflation. And I also wanted to just establish what is the consensus or view on inflation. So I'm sharing my screen. And so if we look at markets currently, the orange line here shows you the US inflation swap market. Currently, rates markets are pricing very high inflation for the next 12 months, so 3.7%. But from next year, the 1 year or the 2 year, 1 year inflation rate collapses down to 2.5%. And if we look at 5 year forward inflation from extracted from the swap market in the US, you see that forward inflation expectations in the US are still relatively benign. So what the market is saying is we are going to see very high inflation in the next 12 months, but thereafter it will start to subside. So that's what markets are saying. On the consensus side, if you look at consensus, CPI forecast, consensus is expecting the current quarter to be a high point for inflation, but it will remain elevated for Q3, Q4, and even Q1 next year. The blue line is where those forecasts were a month ago. So the big April surprise saw inflation forecasts jump up, but then from Q3 onwards next year, it starts to revert back to kind of more normal levels. And this chart here shows you a history of US inflation, headline CPI, from 1990 onwards. And we've seen this spike recently, but consensus is expecting it to fall around there. So the reason for showing this is just to set the scene, what's rates markets pricing, what are economists expecting, and this will be kind of the context for the debate. So now we're going to kick off with Phil's arguments. So Phil is arguing for higher inflation. So Phil, if you reveal yourself. Great.
Good morning or good afternoon to those in London.
Great, good stuff. So Phil, I'm going to kind of pull up your slides, and then you can kind of talk to your slides, and then we can go from there. You'll have 10 minutes. I'm going to just set my timer, my Google timer, on, and so let me start sharing the screen. And also just to put the pressure on you, here's my Google timer. It's going to start, and here we go.
Okay.
So
perfect.
Go for it.
Thanks, Bilal. This is really kind and great to have the opportunity to talk about these issues. And Dominique is a terrific economist and thinker, so I'm kind of interested in learning from her. I'm going to give you my perspective, which is, it's pitched as one side of a debate, but it's basically my forecast. So I'm interested, as always, in trying to understand where I might be wrong. Essentially, I think I've been pushing this story for about 6 months now. I think we're headed for 3% inflation this year and 3% next. Now, what's happened is my forecast for this year no longer looks quite so off track as it did, or off consensus as it did a few months ago. But as Bilal emphasized, my forecast for next year remains on the high side. I would actually emphasize that 3 is hardly 3.25 or whatever, which is hardly a ridiculously high number. It's probably a little too high for the Fed's comfort, but it's not way out of the range. And I would keep an open mind on what comes thereafter. I wouldn't necessarily think we're headed for 3 to 4 to 5 to 6 or anything like that. But I do feel that the next expansion will either be very short because inflation gets us quickly, or will be a higher inflation expansion than any one we've had since the late 1980s, early 1990s. And in some ways, my bottom line is, well, that's actually what policymakers want. So don't be too surprised by this. The general view coming out of the Fed and other central banks has been that we want to push inflation higher. So in some ways, my view is simply they get what they want, rather than something that's necessarily too alarming. Now, to therefore nest my view in something you might call conventional thinking, I'm going to invoke what I like to call the Yellen model, which is a framework for thinking about inflation that Janet Yellen put together when she was, emphasized when she was Fed chair at a speech in Massachusetts in 2015. And the remarkable thing to me about this framework is it's actually been very good, not just at projecting inflation retrospectively since building up to 2015, but actually been very good since 2015 in picking up all the different wiggles that we've had in the inflation rate. And chart 1, I think, highlights that point very, very effectively. So the model really just has 4 sets of variables in it. And in some sense, these are the 4 sets of variables that I would use to kind of characterize where we're going on inflation. The first is the importance of goods pricing, and the way the model expresses it is through the relative prices of imports. But I would emphasize it's really a story about goods pricing, and that's what I call the sharp end of the inflation process. Then there's the one that we've all loved to focus on in the past few years, which is the balance between aggregate demand and aggregate supply in the broader economy, so-called slack. And I would characterize this as broader than labour market slack, broader than the Phillips curve, although we do tend to use the labour market as a way of expressing this and measuring it and thinking about it. The fourth variable, the third set of variables, which is probably the most important one, is inflation expectations. So in some sense, inflation stays low if you expect it to stay low, begins to move up when expectations move up. And then the fourth set of variables, which is quite important to the process as well, is that lagged inflation enters twice in the equation, meaning that inflation has an important inertial aspect to this. We all know that's true, but my point would be once you begin to get the ball rolling on inflation, it can be harder to stop it than you think. And this whole idea of the Fed's very much expressing this view at the moment that, well, it's going to be transitory, but don't worry, we have the tools that will allow us to address it. So that any quick uptick we can quickly get on top of. And I would be a little less comfortable about that. Bilal, can you move on a slide? So coming to the goods price story, which I would emphasize in the next year and a half is the important one. I mean, I think if you take a perspective on, as chart 2 does, on where we've come on inflation in the US over the last 30 or 40 years, really the disinflation process was led by goods. And some of that is what you might call a Volcker effect. Some of it is also an effect that's been highlighted by, for example, Charles Goodhart and Madhwan Pradhan in their recent work on inflation, where they've emphasized the globalization of the world economy, the integration of the world economy after the mid-1990s was a very important inflation restraining device. And I think that shows very clearly in chart 2 in the goods pricing numbers in the US. One of my important points would be that that process has now sort of gone into reverse somewhat. It was going into reverse before COVID with Trump and his tariffs and the deglobalization that was underlying that. And by the way, Biden's done nothing to reverse that. But it's also gone into reverse a little bit because of the dislocations from COVID. So when one kind of looks at the effects that that's having on the global goods industries, you see some extraordinary price developments. Now, those are all characterized as short-term bottlenecks that will go away. But what strikes me is, and chart 3 highlights this with the ISM indices, what strikes me as unusual and what we're seeing at the moment is the generality of these dislocations. I can see some of these issues going away quickly. Maybe we'll start producing more microchips, which will allow us to get on top of car prices. But there are problems across very many broad sectors of the global goods economy that, in my view, will show up in higher goods prices, especially in the United States, but I think more generally. And the used car price data that I show on the right are really quite spectacular. So let's move on to the next slide. So we generalize from this point of acceleration due to goods demands and problems in the goods sector to the issue of broader slack in the economy. And you could say, well, there's no problem because the unemployment rate's at 6.1%, and we know NARO is at 4 or below. So therefore, no problem whatsoever. I would be a little less comfortable with that assertion for a number of reasons. Most importantly, I can see us looking at a very good, strong run for for US demand, global demand, but US demand for the next few quarters. One of the more spectacular developments is the way that the saving rate has risen, even as wealth, chart number 5, even as wealth has soared. There's been a restraint on the consumer due to COVID, which is going to come off in coming months and quarters. Investment demands remain very strong. So aggregate demand in the United States is going to be very strong against a backdrop of a lot of dislocation. We talked about goods, but also in the services sector caused by COVID. And one of the features I think is so striking is how the labor market remains very dislocated, with an unemployment rate that's still at 6.1%, but other broad indicators of labour market slack, which are currently approaching previous cyclical highs, as reflected, for example, by the NFIB and Conference Board data. And then there are some sectoral issues, most obviously housing, and how housing feeds through into the CPI is somewhat complicated and mysterious. But I think the leading indicators of house prices are pretty clear in terms of giving us a lot of potential upside for CPI shelter as we go into next year and the year after. Go on to the next slide, my final slide. Well, there we go. So now we get into this whole issue, which I think is crucial, of inflation expectations. Because I think we'd all accept that you can get these temporary bouts in inflation that come through and then fade away. To get the ball rolling, you need not just goods price dislocation, goods price inflation, tight slack, but you also need a sense in which this begins to change consumer and business expectations. And I would put great store on the business side, not so much the consumer side. And I think this Atlanta Fed survey is worth watching. The Atlanta Fed takes a survey of business expectations for the year ahead. It's gone from a very gloomy picture, understandably, in April of last year, to a much different environment today. And I think this comes back to the notion that what's going on here is a change in the way businesses perceive the inflation picture. They're being told by the Fed that no longer do they have to hold the line on prices. They should expect higher inflation. Most important of all, there's, I think, a perception and a recognition that the supply curve in the global economy shifted somewhat from being a very elastic supply curve. In other words, you could sell all you wanted, but it had to be at a given price, now to one where there's much more of an upward slope to that global supply curve. Another way of putting it is companies now perceive themselves to have a little more pricing power. So the way I'm thinking about it is that higher costs in the last few months and in the next few months will feed through into higher prices. And then just to add the icing on the cake, I don't think it's crucial, but I think it is important. Consumer inflation expectations are now rising, not just at the 1 year ahead level, but at the 5 to 10 year ahead level. So that's my message. It's not one that's kind of the crazy money supply approach or anything like that. It's based very much nested around the idea that if we use conventional thinking, conventional Fed models, we get the sort of result that says, with everything we put in at the front end, looks like we could easily get 3.25% inflation in 2022.
Great, thanks for that, Phil. And you kind of were just within your 10 minutes. Well done.
Sorry. Maybe a smidgen over. I apologize.
Great. So let's go to Dominique now. So if Dominique, you kind of open up your camera and everything.
Bilal, you need to open my camera.
Yeah. Okay.
Yeah.
Hopefully that works. Great. So like with Phil, so welcome Dominique. Like with Phil, 10 minutes to give your view. Let me just share the screen and start the timer. Okay, go for it.
Thanks very much. The clock is ticking, so I'll jump straight into the topic and try to give a complementary perspective to my esteemed friend and colleague, Phil, who I think made a very compelling case. I'm taking more of a big picture approach, and my ideas are very simple. Before the crisis, we were stuck in a low inflation regime due to structural factors. Now, those structural factors have not changed, And so once we get over the pain of reopening, shocks of various natures that Phil mentioned, I think we'll be back to the old low inflation regime. And to make my case, I'm going to invoke two economists whose names start with a K. Next slide, please. The first one is Kuroda. And Kuroda knows a thing or two about inflation because he's been at it since 2013 when he became the governor of the BOJ. And one of the things he's been lamenting is the absence of a wage price spiral, which is basically wage and prices feeding on one another, which is another way of saying that the Phillips curve is too flat to have inflation. And the reason the Phillips curve is flat, I think I have not changed since the pandemic. And we know them. They are globalization, technical progress, pro-employers law and regulations, also employer concentration. There are fewer and fewer employers to choose from. And I would argue that these factors are still there. And that, for instance, the technical progress is likely to be stronger post-pandemic because in order to survive, firms have had to innovate, and indeed faster labor-saving technologies is one of the scarings and that Chair Powell is concerned about. So let me give you a specific example of how this lack of workers' market power that is driving the flat Phillips curve. I mean, basically, even if there is very low unemployment, workers cannot extract wage increases. Let me show you how that works. Next slide, please. So on the left-hand side, I'm showing you the decline in the ratio of the price of consumer good in the CPI and the PPI. It's a secular decline. And what it means is that the margins of producers have been falling. That's the blue line. However, what seems a bit inconsistent is that manufacturing profit as a share of manufacturing GDP has not been going up. It's actually been a bit volatile, but overall trending up despite the decline in margins. And why is that? And that's where my Phillips curve, weak bargaining power of workers story comes into place. I'm showing you on the right-hand side the ratio between wages and GDP per worker, productivity. And it's been falling. And so what's been happening is that employers, because of workers' weak bargaining power, have been able to use productivity gains to offset costs rather than raise wages. And that's how they've kept prices low while maintaining their profit margins. However, this has had negative consequences on inflation, not just through this wage price mechanism, but also through aggregate demand. And there I'm going to invoke my second K-named economist, Keynes. And Keynes, I think, is telling us a couple of things which are really helpful in understanding this low environment, low inflation environment we are in. First, the paradox of thrift. The idea is that if everybody wants to save because somebody's consumption is basically demand for everybody else's production, high individual desired savings are self-defeating. And the other aspect of Keynes' thought that I think is very relevant today, it's his criticism of the loanable fund theory. And not to get too technical, but the idea there is that all of the savings goes to fund investment in the corporate sector, to simplify things very much. And actually, Keynes said no, savings can also fund the acquisition of money. Now, in Keynes' day, the financial sector was nowhere as big and as sophisticated. There was no consumer credit. There were no derivatives. But the idea there is that savings can be used to fund financial investment or tangible investment. And typically, with higher desired savings, the demand for financial assets tends to be higher, and the demand for tangible assets, for goods and services, tends to be lower. And so higher desired savings tend to make for higher asset price inflation and lower CPI price inflation. So let me give you two examples where I think Keynes' thinking is very much relevant. The first one is aging. People age, they want to save more, and they continue saving, interestingly, well into their 70s. And as we well know, the world population is aging. And here, by the way, I'm showing you as a measure of aging, the share of children in the population. And I'm doing that for three reasons. First of all, children don't save. Second, anyone who's had to raise children knows that saving, when you have to pay for their upkeep and education, is difficult. And third, we've done some research on this topic at Macro Hive and found that what was really significant for inflation was this share of the young rather than the dependency ratio. But you can see that, interestingly enough, in a place like Germany, it's stabilizing. However, what's coming and what's going to hit us, and probably is hitting us already, is population aging in EMs. And we all know about China, but what about places like Africa, even India? Fertility rate in India are at the replacement ratio and falling. So that, I think, is going to stay with us for a very long time and keep our low inflation environment. The other trend, next slide, please, is inequality. Because what happens with inequality is that, as I show on the left-hand side, households that have a higher propensity to save are upper income households. So basically, when we have high income inequality, the increase in income or increase in money tends to fuel the demand for financial assets rather than the demand for goods and services or for tangible investment. And some economists in the US, me and Sophie, for instance, have started to talk about the savings glut of the rich that's associated with high inequality. And that, I think, is also a trend that has not been changed by the pandemic. So my time is nearly up. I'll make 2 points. No question, weak bargaining power of workers, aging, inequality are with us. Inequality, I think, is a factor that could change due to political development, but it will take a few years. And that's why, in terms of my inflation forecast for 2022 and your inflation forecast, definitely in my books, closer to 2 than 3%. In fact, could be even below 2%.
Great, great. Thanks for that, Dominique. So what we'll do now is we'll take just a few moments for both of you to sort of collect your thoughts on how to rebut each other. So Phil, you'll go for 5 minutes to rebut Dominique's points, and then Dominique will then have 5 minutes to rebut your points. Phil, are you ready, or should I?
Sure. Yeah.
Do you want to go for it? Okay.
And I mean, I think you're trying to get a boxing match started here, Bilal. But
yeah.
I'm no Mike Tyson, and I'm not going to rise. No, seriously, I think one way of thinking, as with so many things in economics, one way of thinking about this is we're looking at things with a slightly different, often a different time perspective. A lot of the points I was making were relevant to, the next year and a half, which I think is an important, for investors, a very important phase to be thinking about. And as I said, I think at the beginning of my comments, I'd keep an open mind about what comes next, whether we stay at 3, go higher, or drop back down. And I think Dominique made some very good points about, as she called it, the structural factors which have given us low inflation looking backwards. One of the most important messages I have is I think those factors are changing. So it's not so much a rebuttal; it's just a different take on some of the these factors. Let me just mention a couple of them. Actually, one thing I think is very important to emphasize is I think we've all got way too focused, including especially the Fed, way too focused on the labor market as our sort of trigger to the inflation process. As though it's the unemployment rate and the Phillips curve that drives everything. I think if we've learned anything from not just the last few decades, but especially the last year, it's the Phillips curve is remarkably flat. And remember, this time it was flat in the other direction, meaning we caused unemployment to go to extraordinarily high levels, and we didn't affect inflation or wage inflation seemingly on a durable basis. So I think the way I'd look at it is it's got a lot to do with business decision making. And I think what's changing here is that the business environment has gone from a 20-25 year period of thinking of itself as operating in a perfectly competitive market where you had no pricing power, to realizing those conditions have changed. And they've changed for a number of reasons. By the way, one of the reasons they've changed is actually the growth of big tech companies. And I would push back a little on this idea that big tech is great for keeping inflation low. I think there's a lot of evidence, especially work being done by the guys at the Billion Price Project, that shows that people like Amazon, the Amazon effect, if anything, can actually be to raise prices, raise margins for Amazon, and keep the inflation process going. The other point I'd emphasize, and I didn't make anything of it in my presentation, but I wanted to come back to Dominique because she emphasized it, is this role of demographics. And I guess, again, I have a very different perspective on this. I think the period, if you think inflation is really all about aggregate demand and aggregate supply, the period of the last 20, 30 years has been this wonderful period where, this is the Goodhart-Pradhan point, where you had an amazing supply of labor on the global market, providing goods, and a relatively low dependency ratio. Now what's happening is, the dependency ratio is beginning to rise very sharply, as Dominique emphasized, not just in Europe and DM economies, but especially looking ahead in many emerging economies, especially in China. So we're going to get a lot more people living longer, demanding stuff, being produced by a lot fewer people. Now, you can say productivity is going to get us out of the hole, but I don't think that's an automatic given. So I think the demographics in my book, and again, this is not something I'm focused on in my inflation narrative for the next year and a half or two, but the demographics in my book actually make the inflation outlook more challenging in the next decade than less.
Okay, great. No, thanks for that, Phil. And you've kind of stuck to your 5 minutes. As it happens, I have Charles Goodhart as one of my podcast guests in the coming week, so I'll be able to kind of press him on his different sort of views there. So, Dominique, let's go to you. You have 5 minutes to take on Phil's points.
Okay, so I think Phil's points are well taken, but here are my answers. So the risk of higher goods prices, I just don't see that happen for a number of reasons. First of all, you, as I think Phil mentioned, deglobalization. So the stabilization or the decline in the ratio of global trade to GDP, it's been with us since the global financial crisis, and yet we've seen goods prices deflate. When we look at the the impact of the Trump tariff, even on not on import prices, we see a very limited impact. It's basically importers used margins to absorb the higher tariff. I would also argue that it's not just globalization that is driving goods price or has been driving goods price deflation, but it's technical progress and chips. Just about everything we use, any widgets, as we see from the shortages, uses chips. And in fact, if you look at chips prices, they are deflating because they have always been deflating because of productivity gains. And despite that, if you look at the ratio of sales of global sales of chips to GDP, it's been rising post-crisis. So I would say we will see the continued productivity gains. I actually am, I have big expectations on the impact of a decentralized ledger technology on the economy. So that's my first point. And my second point on that is, even if I'm wrong and we get a bit of a goods price inflation, if workers do not have the bargaining power to obtain higher wages to offset that increase in the price of goods, then inflation will go nowhere. We will have a step increase in the price level, a decrease in real wages, an economic slowdown, and slower inflation. Now, the other thing that I want to talk about was Phil's point about rising expectations. I think the data is there. I think it's a very, very fair point to make. But let me ask you this. How many people, what is the percentage of the US population that knows that inflation is at 2%? I mean, what I'm saying is this is a nebulous concept. Most people, when inflation is low, really can't make the difference between 2 and 3%. Obviously, if the US was Argentina and we had double-digit monthly inflation, people would pay more attention. But where we are, there is still, I think, an enormous degree of inertia. And I would cite as evidence the jump in inflation expectation around the global financial crisis that didn't last. So I'm not too worried about inflation expectation. I have a nagging suspicion that this is a concept that central bankers like because it fits their model, but I'm not very sure how important it is in everyday economic reality.
Great. Okay. No, thanks for that, Dominique. So what we can do now is we can open up to kind of questions. So people are already sending in questions, but there's kind of a Q&A icon at the bottom of the Zoom thing, and just type in your questions. I'll kind of filter through them all and then start sort of asking the questions. But both Phil and Dominique, if you kind of if you kind of show yourselves, I'll ask the first question from my side, and then we'll go to questions from the panelists. I guess my question is just the classic one. Why hasn't Japan created inflation? They've got an aging population, large kind of public spending programs over the years. They've been printing money and so on. So why hasn't Japan created inflation? So maybe Phil, let's go to you first, and then I'll go to Dominique.
Yeah, I mean, one way of looking at it is they were doing this in this benign, I think we all agree, looking back, we had a benign 20-year period, and they took advantage, well, in some ways they took advantage of that by, being able to have, all these policies without generating inflation. Reality is they also had very sticky expectations, and I sympathize a lot with what Dominique said about expectations being somewhat overhyped by central banks. But I do think Japan is a clear case where, as Kuroda loves to say, there was a deflationary mindset, which, by the way, I think has changed. I think that's the big event of Abenomics, was he got them out of a deflationary mindset.
Okay, and Dominique?
So I would add two things to what Phil has said, and I agree with him. One is fiscal policy, not as expansionary as you believed. If you compare the Japan and the US, since 2010, I believe, since the GFC, the deficit has been larger in the US than in Japan. Now, the other reason why we are not seeing inflation in Japan is the labor market. So there is a dual labor market in Japan, with people who have life tenure and people who don't. And basically and people who don't have life tenure are paid much less. And whenever the economy grows and the demand for labor increases, typically firms try to hire non-tenured workers with lower wages. So that, I think, creates a sort of disinflationary built-in bias.
Okay, no, great. Okay, understood. Okay, there's kind of a bunch of questions we're getting. There's one set of questions that seem to revolve around kind of Biden policies. So, how much of kind of current labor market issues are due to, like, labor market slack is due to the unemployment policies, the insurance scheme, that keeping people from getting jobs, and then also, isn't Biden going to try to help unions, so increase the power or the possibilities of unions? And also another point, if Biden is very intent on helping low wage earners, won't increasing inflation hurt those low wage earners, if that's kind of, if you see what I mean? So there's a couple of questions around Biden. Phil, do you want to take that first?
Sure, and I'll be very brief. I mean, I think I wouldn't, I think a lot of what Biden's trying to do is promote low wage, fortunes. I'm not sure how successful he can be at that, if you see what I mean. The programs for extended benefits, I think, have been relevant to kind of keeping people away from going back to work. But most of those, even if they haven't already expired, as they have in some states, will expire at the end of September. So, in the relatively short term, we'll be beyond that issue. And clearly he's got an agenda to try and promote union interests. Again, whether he'll be successful or not, we had the famous case just a month or two ago where Amazon workers in Alabama rejected forming a union. But my point all along is, don't make too much of the bottom-up wage pressure phenomenon in terms of driving the inflation story. To me, it's all about businesses perceiving themselves to have pricing power and pressure to raise prices. The other angle, I think, is kind of important in this is a secular story. In other words, I think the labor share of income in some sense hit rock bottom in the middle of, and I think Dominique actually had a chart that showed this, in the middle of the last expansion. And things like Brexit and Trump himself were actually moves by the population to try and reverse some of this. So populism, which is a feature across many DM economies and EM economies, is something that I think reflects this sort of pushback against the corporates running the world. And I think I wouldn't put that out there as the major factor, but I think it's a relevant factor, and it's a secular factor, not so much a Biden story.
Understood, Phil. And Dominique?
So I completely agree with Phil about populism, and that's a core reason of my medium-term view that inflation is likely to accelerate, though not next year. But in terms of the Biden policies, just a couple of things. For sure, he wants to raise the income of, the bottom earning Americans. But so far he's done it through fiscal policy, which I think is very unsustainable. I think he needs to do it through structural measures, such as, there is a law in Congress to increase workers' power. The problem is you need a bipartisan consensus. And then I think we are heading there because, interestingly enough, we have prominent GOP senators. I'm thinking of Marco Rubio, for instance, who are turning really pro-union. But again, I don't see it happening this year or next. I mean, all of the focus this year or next is about the midterm. So we're not going to see those deep structural changes happen in the short term, but definitely they are coming. Meanwhile, short term, I don't see Biden's policies raising inflation for the reasons that Phil explained very well.
Okay, we're also getting a bunch of questions on the money supply side of the equation. I mean, both of you didn't really talk much about that. So, we've had this massive expansion in M2 growth. What's your view on the impact of that on the economy? Will money velocity pick up? Another related point is that what we saw after the GFC was that although there was large expansion of the Fed balance sheet, commercial bank regulation was such that credit didn't really extend into the economy, and so ironically, even today, it's not very easy to get credit. Somebody says scarring effects of GFC have created an aversion to debt from consumers, and bank regulation makes supply of credit, particularly to low credit borrowers, virtually non-existent. So, I mean, that's kind of the other side of the money supply argument. But how do you think about the whole money supply credit sort of side of this? Maybe Phil, you go first.
Okay. Yeah, I would downplay it somewhat, although I think the way to think about it is it's a key ingredient to the aggregate demand story. So in other words, I worry that economists have got these incredibly unstable views of what drives inflation. One decade we chase one hare, one decade we chase the next, and I guess I like to think of myself as someone with a somewhat stable view of the inflation model, and it's that Yellen model I talked about. And so what really matters, like the heart of it in some sense, is the relationship between aggregate demand and aggregate supply. And one of the points I've been emphasizing is I think the shape of the aggregate supply curve has shifted somewhat. We can debate back and forth on that, but I think the aggregate demand curve is key. Typically is what drives the inflation rate. So it's why it goes down in recessions and up in booms. And I think of monetary policy as not the only driver, but a key driver of that. So all this excess liquidity, in some sense, is a good indicator that aggregate demand is going to remain strong. I mean, if I'm wrong on that and aggregate demand is weak, then all bets are off on inflation staying high. So, integral to, maybe I should have emphasized this very clearly, is integral to my thinking is the US economy that grows something like 8% Q4 on Q4 this year and about 4% Q4 on Q4 next year. And a lot of that is supported by very generous liquidity.
And Dominique?
Okay, so my philosophy on the money supply is follow the money. For sure, the Fed balance sheet is increasing at an amazing rate. But if you look at the ratio in the increase of bank deposits, so broad money and the Fed balance sheet, it's actually falling. And it's falling because banks cannot find borrowers. Credit is actually contracting. And if you take out, and that's credit including the PPP loans that are basically subsidized by the government. If you take out those, credit is contracting even more. And then what is credit funding? This is again the point I made during the presentation. A lot of the credit that's being extended is funding financial assets that are claims on other financial assets rather than funding either investment or consumption, or funding financial assets that are themselves providing credit to the corporate sector.
Okay, no, thanks for that. I mean, we're coming up to sort of our time. I just want ask one final question, which is a good one on the sort of the risk sort of distribution. I mean, this is particularly like investors. I think this is an important one. So, if you had to choose of the tail risk of the US hitting, say, 7-8% inflation in, say, the next 3-4 years, or hitting negative inflation, like deflation, in the next 3-4 years? Which risk would you be skewed towards? Dominique, maybe I'll ask you first. If you had to pick one of those.
Okay, so I'll pick deflation. I just, there are some serious risks out there in the corporate sector. If the recovery disappoints, we have a super leveraged corporate sector. If they can't get the cash flow to service their debt, we are in trouble. I see this as more of a risk of 7-8% inflation.
Okay, and Phil? I can guess what you're going to say, but
a bit dishonest if I went the other way. But no, I mean, I think part of the problem is our issue of what we mean by how we measure it and all that. And I can see us easily getting to 7% headline inflation at some point, maybe in a few months. It's more this sort of sense of the trend and the core inflation, et cetera. And I think, my fan chart would be skewed to the upside, but it would also have a little bit of a characterization that it might look like a roller coaster, because I worry that if we get too much inflation in the next 2-3 years, it's going to create a very negative economic environment that will bring us crashing down. So I wouldn't be hoping for higher inflation. I worry about it.
And Phil, you mentioned roller coasters. Is there a reason why roller coasters are on your mind at the moment?
Well, I happen to be sitting here in Walt Disney World, which is a great example of COVID effects on the economy, because they've cut capacity by about 30-40% and raised all prices by about 50%. So, there you go. There's the growth inflation trade-off as per Mickey Mouse.
And Phil, just checking, are you there just you and the wife, or is it? Are there some young kids as well? Is it just one of the things you like doing?
No, I have four 20, 30 somethings, and the way they do Disney is different from the way 3- and 4-year-olds do Disney.
Okay, I'm not going to ask. Yeah, okay, that sounds good. So just big thanks to both of you. It was a great sort of debate. I mean, just for the viewers of this, we're going to have a replay where you can sort of view all of this, a recording. If you want to get hold of the presentation, just ping me a message, Bilal@macrohive.com. Also sign up on our site, macrohive.com. And if you're interested in the institutional product, drop me an email as well. We can give you a demo. Also, in case you don't listen to our podcast, please do listen to our podcast show. It's very popular. And, our next one is out tomorrow. It's with the former UK Chancellor, Sajid Javid, is the guest on the one that's coming out tomorrow. So it should be a good one. So with that, thanks to the speakers, and thanks to all the viewers and listeners, and good luck on trading inflation for the next 12 months or so.
Right. Thank you. Thanks, Dominique. Bye-bye.
Bye, Phil.
Bye.